All right, welcome everyone. I hope you're all doing well. In this video, we will be looking at three price expectations after price takes liquidity or after price takes a significant high or low. This will be a continuation of the last video that I did, which went over one of the price expectations. In this video, again, we'll be looking at three price expectations and looking at how we can find potential setups with two of the expectations. Okay, once you fully grasp this concept, I believe you will not look at price the same again. I don't think you will find this information packaged the way that I have packaged anywhere else. These concepts, they are quite simple and they are adapted from other places, of course, but packaged in a way that I don't think is has been explained before in other places. So I hope you enjoy this video. If this video helps you out, please like and share and subscribe if you haven't already. I really do appreciate that. And so let us begin. So, do you trade ICT? Do you trade market structure with supply and demand? What I call MSSD? Do you have problems entering trades too early or missing trades? Do you have problems choosing the right zones? Understanding the three price expectations after taking a significant high or low can help you, right? This can help you to read price. It can help you to avoid some early entries if you know what to look for. It can help you to have a higher probability where price is at a reflection point, at a point where it's about to turn. It shows you how to trade specific zones and points of interest. So yes, let's start. Let's move on to the first price expectation. So the first price expectation is immediate change in order flow, right? So in this diagram below, we have a downtrend. We have price retracing back up, seeking internal liquidity. As soon as price takes internal liquidity, we see immediate change in order flow to head back to continue the higher time frame trend. Right now, this concept has been taught before. There's nothing new under the sun. ICT taught this quite extensively with the 2022 model. In his ICT 2022 model, he was looking at price taking liquidity, and he would often call this the Judas swing, right? Expectation for a retracement to take eternal liquidity before continuing with the higher time trend. And what he would look for in the specific 2022 model was this pattern, right? So this pattern requires a market structure shift. Okay, so you have on a lower time frame market structure heading up. Then you have liquidity taken. You have immediate sharp displacement down. This displacement down often goes down with some energy, leaving behind some fair value gaps, right? So it displaces these breakout traders, right? So you have breakout traders buying this breakout, going long at the break of a significant level, right? And that often becomes trap buyers, which fuels a move, a likelihood for a continuation to the downside. All right, so this is the 2022 model, market structure shift with displacement, with the fair value gap, and you enter on the fair value gap for continuation down. All right, this is similar to what other maybe some gurus are teaching online, such as the sharp turn. I believe that's coined from Arjo, who teaches ICT concepts. In his model, he looks for the same thing. He looks for a fair value gap to the upside to take liquidity, and then a fair value gap down that immediately disrespects the first fair value gap, right? Often this will also be called inverse fair value gap, or you can consider it to be a unicorn entry. Honestly, there are so many different names for this setup. And most of them are all saying the exact same thing. Some of them have some small nuances as to when to actually enter, but ultimately it's the same thing. You're taking a significant high and you're looking for that immediate change in order flow, right? Before ICT, there was swing failure pattern. So I believe before people started calling it the 2022 model, people used to call this actually the swing failure pattern. And there are different ways to enter. For swing failure pattern, I've seen the entry right when price returns back below the liquidity point. For example, here we have liquidity that's taken. As soon as price falls below the liquidity point, I've seen some people enter based off of that, based off the energy, the sharpness that it came back below liquidity point, right? But more often than not, um, you do want some sort of change in state of delivery, right? So the higher probability, in my opinion, is if you get that market structure shift and you have some signs that we are changing, have a change in order flow to head back down, and you're looking for an entry on the retracement, and maybe even going down to even lower time frames to find an even more precise entry to enter on, right? So this is the first price expectation, right? Price following the higher time frame trend, retracing back up, taking significant liquidity into a point of interest to the left, right, and having an immediate change in order flow. When this happens, it becomes quite obvious. You want this to scream your name. You want a sharp turn down. You want a market structure shift, and this trade becomes fairly high probability trade to find to enter on towards continuation. Okay, so model number one. Model number two. Right, this is the model that was explained in the previous video. This is basically accumulation, manipulation, distribution on steroids. This tells you where to expect AMD, right? AMD is a ICT concept, um, but obviously it comes from many other disciplines as well. Here we have some wick-off accumulation schematics. You have different things going on here. Even other places talk about after taking a significant high, you expect accumulation, which is what we normally expect, right? So again, first expectation is you have immediate change in order flow. The second expectation is we have accumulation, right? So when we have accumulation, when we you can spot this quite easily, right? So compared to the first model you had immediate change in order flow. You had immediate fair value gap back down. You had immediate market structure shift. You have starting to change order flow to head back down, and that becomes somewhat quite clear. Um, when it says accumulating, um, you can be tricked out sometimes where it looks like it's a change in order flow, but then you immediately have a change in order flow back to the upside, right? So it oftentimes it may just have a sharp move down, but not actually doing an MSS, a market structure shift, and heads back up, and then you see that it is accumulating and is continuing to maybe create some zones at the top of the range. Maybe it's heading up slightly to the upside. Maybe it's reaching for something else. But typically, accumulation is also once you have enough chart time, once you do enough back testing and spend time looking for these price expectations, you can start spotting these fairly easily, I would say, right? So price takes a significant high and it starts to accumulate, right? After price accumulates, this is now at the top of the range, right? We're expecting price to move in waves. So maybe not necessarily to come back and continue the higher time frame trend, although that does occur quite often, but oftentimes it will retrace back to maybe to discount to equilibrium before continuing maybe to break this higher time frame downtrend. It's going to change and go to the upside. So you'll be able to see that. So once you have accumulation, this is where you are expecting the final manipulation tap. Generally, it's in the point of interest, which is going to be a supply and demand zone or fair value gap, or or maybe another higher time frame high or low liquidity point. So you'll have to get used to looking at that manipulated move. But again, typically it's accumulation, final manipulation into a point of interest, and you have a distribution. And if you backtest this, it almost pretty much always goes for the accumulation lows at least, if not further down. Okay, so this is the model number two, price expectation, after price takes a significant high or liquidity point. Now the third expectation, quite simple. right? The third expectation is a run on liquidity, a run towards the next objective. Right? In the diagram below, we have price running with energy. So obviously it's not doing a sharp turn like Model 1 where it's not changing order flow to the downside. It is not accumulating as we would expect. Accumulation typically smaller range, smaller zones, smaller swing points to eventually get taken later on, right? The zones at the top of the range tend to get liquidated, right? But here we have a strong move up with energy. We're leaving fair value gaps behind, right? And so once it starts doing this, right, you're expecting price to continue. You're expecting price has an objective. It's reaching for something else, right? So it's saying that it's not satisfied with this liquidity. It's reaching for the next liquidity, or it's reaching for a next objective, right? So sometimes it could be reaching for the mover region or a supply and demand zone. And once it does that, because it's moving with such energy, you know, you may not want to take that short. You may not want to enter at the 50% if that's your entry technique. If you're entering 50% of zones, right? When you see price moving with this type of energy, right? Oftentimes it's going to run that zone, right? Now, if it reaches that zone and then it starts giving you some stalling and it actually starts giving you that displacement down, then you can look at potentially an entry, a more conservative entries once you actually see signs that price is showing your hand, showing its hand, right? So these price expectations, it's waiting for price to show its hand, right? It's not limiting order to find entries. It's waiting for price to show you what it wants to do, and then finding a conservative entry, a less risky entry based on the three price expectations, right? So as price is running up, right, it's likely reaching for another objective, maybe a higher time frame metric, maybe it's spooling up and it's going to continue up for a long time before it finally cools off, and maybe the next day or a couple of days, then that's when it's ready to retrace and move in waves like normal price expectation, right? So you don't want to be catching price as it's moving like this, right? When price is, for example, dropping like a knife, you don't want to catch a falling knife, right? Because for anyone who's actually tried to done that, you know that you will get cut up, right? It can just drop and drop and drop. It may start to maybe look like it's gonna bottom out and then it drops again. And that's because price is spooling. It is moving with such energy, right, that it's reaching for something else, not reaching for these liquidity points, right? It is reaching for something else. And so you want to, by seeing this, this should be a trigger for you to not look for shorts. In fact, if price is starting to give you some opportunities to the upside, right? Small retracement into fair value gap, small retracement into zones that it's creating, you can actually look for longs even though that is at the top of the range, because this is not the top of the range on a higher time frame. It's reaching for something much higher. So your understanding is that it's spooling up. So if you never got any entries down here, this is the only scenario where price is spooling up where I may actually consider to continue looking for longs until the higher time frame objective is met, right? If I start to see accumulation, right, then I'm generally not looking for any more longs. I'm looking for shorts, right? If price does an immediate change in order flow, I'm looking for shorts until we reach to an area of discount, or depending on what the higher time frame market structure is looking like, right? So this third price expectation is going to be very important to keep you out of losing trades, right? Instead of just entering blindly at the 50%, right? Don't take these setups unless you actually see a change in order flow or something more, because this is very likely to reach for the next objective. Okay, so let's look at some examples and hopefully you will start to see this more clearly. Okay, so let's look at some chart examples. One sec. Okay, there we go. So I have in front of me a chart of NASDAQ or NQ. This was last week's price action while doing my own back testing and trading. I've marked off some examples for us so that we can look at the three price expectations. So let's look at this, right? So here we have a downtrend, obviously, right? Um, price here comes up for due to swing, takes liquidity, right? And obviously, as price is moving down, we have late comers, we have people selling as it's going down, and where do they put their buy stops, right? Where do they put their stop loss limits, right? They put it above old highs. Excuse me. So price retraces back up, takes the liquidity, and has immediate change in order flow. Now this one looks a bit different, and in general, right, price always looks different, right? It provides different variables all the time, but the principle is there, right? It has an immediate change in order flow, right? This one, not necessarily a market structure shift, but this one, you can look at the sharp turn, which you have fair value gap up, fair value gap down, and then enter on the fair value gap, or you can look at this as the swing failure pattern, right? But this one, or if you ignore the wick, you do have the market structure shift with the displacement and then tap into the fair value gap and then down. All right, so price expectation number one. All right, similar to this one. All right, price is trending down, price retraces back up, takes significant liquidity into a fair value gap, and you have an immediate change in order flow. Right, so here you can look at some liquidity down there, comes up, taps it, trades back in, trades back down. Right, so you'll see this pattern happen again and again and again. I mean, if you did not get your entry there, price also came back up and gave you kind of a similar location for another short down here. But let's look here a bit further. All right, so price comes down again, takes some liquidity. Now this one would have been a bit tricky, right? Because you had some resemblance of the 2022 model here, but there's no follow through, right? So a couple ways you can look at this is you can go down to even a lower time frame and look for some additional confirmation, maybe some sort of candlestick structure, seconds based valid high, and then enter. Or number two, if you look at this one, you can also wait for price to come into premium, right? In this scenario, this is at the bottom of the range, right? So wait for price to come into premium. All the other examples, right? All the other examples, price came into premium. Right, here's premium. This one as well. Price came into premium. Right, so when you're looking to take trades to continue the trend, in my opinion, you guys can backtest this. This is looking for premium discount will help you quite a bit. Right, so price comes back up, and so here we don't really have the change of order flow down. We have immediate change in order flow up. So this was somewhat of a fake. So price takes liquidity again, and we have number two, accumulation. Right, in this one, it's a bit of a mix of accumulation and a run, because here we have the accumulation and price ends up shooting up, and actually shoots up with energy and actually reached for another liquidity point, which is a liquidity point right here. Right, so you can look at this as number two, where you have accumulation and then manipulation tap. All right, manipulation tap. Target the accumulation lows. Excuse me. And so there you have the price expectation number two. Or you can look at this as a combination of 2 and 3, where we have accumulation, a run to the next draw on liquidity, and then you have some resemblance of a lower time frame flip, right? So you have immediate change in order flow after taking liquidity. So price expectation number one, or you can say this is just price expectation number two. Okay, so price continues down, right? To the left, there's a significant low to the left. That's much farther away. So we eventually take that low. We take this low as well, and from there we have price expectation number two. We have some accumulation occur. Final manipulation tap into 50% of the point of interest. Then we have our move back up, first taking out the accumulation and eventually running liquidity. Right, so price expectation number 2. Right, and here we have a really strong move up, right? So this you can even consider this number 3. Right, so price is taking out some highs, right? So we have it did get a little bit tricky, right? But here we have clear accumulation, right? So there's no displacement down, no change in order flow, so we have accumulation here, and then price continues to run. So has price expectation number 3, takes out this high, again stalls a little bit accumulation, but it's still running, right? So when you see price running, your expectation is that it's reaching for a higher time frame high, which ended up being this high of a swing point, right? As soon as it takes this high, what does it do? It has a change in order flow, right? Tap back in to fair value gap, and then you got a nice trade, right? So not necessarily expecting price to come all the way here and make a new low, but you're getting 1-to-1 and some, maybe a 2-to-1, or reaching for this swing low. Then generally would be a nice target. Or if you consider this even number 2, where you have accumulation, manipulation to not really a point of interest, but to take liquidity and then back down to take out the accumulation. Did it hit the accumulation? Nah, just missed it. So not really number 2, but definitely number 1. All right, so price now is looks like it's heading to the upside, right? In the short term, right? Price goes up with energy, right? So you're not really expecting these highs to. You don't see obviously number 1. Now that it took this liquidity, you're seeing some resemblance number 2. But we're so close to a higher time frame liquidity point, so it runs that liquidity, and then what do you get? You get price expectation number 1. Right? Again and again and again and again. Price expectation number 1, I would say, is the most frequent, whereas then number 2 also gives you a quite nice trade if you can spot this. Right? So price comes down. Lunchtime takes us low. Looks like number 2 is here as well. Did not mark this one off. Right, so no change in order flow to the upside. When you don't see change in the order flow in the opposite direction, you should expect number 2. Right, so always expect the 3 price expectations. If you don't see 1, you see 2. If you don't see 2, you expect 3. And in this case, you don't have 1, so you're expecting 2. You're not entering right away, right? You're entering only when you see those things. So here you have price expectation number 2. Finally has a manipulative tap into taking this low into this move origin, and then you have a nice trade to minimum take out the accumulation high and to attack some of these highs here as well. Right, price does it again, comes back down. Right, so this could also be just the inducement. If you don't trust this one, right, you don't trust this one, you're waiting for a 50% tap. Well, it does do that, right? It comes down, takes out the significant low, and then you have price expectation 2 again. You have the accumulation occur. You have the final manipulation tap close to the 50%. Then you have the strong move up, right, to what the minimum accumulation highs, and starts attacking some of the liquidity to the upside. Right, after taking this high, right, this one would have been a bit tricky. This one you did get, well, not immediate, right? So you did not get immediate change in order flow, right? So no MSS, right? So as soon as price failed to do the MSS and it came back up like that, then you know that this is accumulation. And so, it did do potentially maybe a trick here, right? Some people might have been tricked off of that, but it wasn't immediate. It was accumulation, and then if you say you entered here, as soon as you see that it headed back up again, you can cut your losses, right? And so this ended up being number 2. Then it ended up being number 3. So we had number 2 here. Right, some accumulation. This is really small though. Accumulation, manipulation tab, we're down to the accumulation lows, right? And then you had number 3. So as price is spooling up, no accumulation, no change in order flow, you're not taking trades from this point of interest. You're expecting it to be ran, so it went quickly, in a hurry, with an objective in mind. So it ran there, took out the high, and we see no change in order flow to the downside. We start to see accumulation, right? So this accumulation it's like a number 3 and number 2 at the same time, right? So number 2, this is a higher time frame accumulation, so we do see this accumulation for a good amount of time. We also see that the accumulation started to head up, so it's not necessarily in a range like straight, so it is moving up with some energy as well. So in this scenario, as price is moving up, you see price moving. There's some fair value gaps, fair value gaps, fair value gaps. It is balancing itself on the way up. So it's not quite like it's going in a hurry, quite going with energy, but it is somewhat going up. And so you do know that it's looking for some sort of next point of interest. So it's reaching towards an objective, even though this is a type of accumulation, right? So you have accumulation, and then you have um, reaching for this high. There's a high to the left, right? High to the left into a point of interest, right? And then you have an immediate change in order flow, and you trade it down. Or if you looked at this as being the accumulation, right, then you can also, you know, take the trade to the accumulation lows, right? So this is a bit of a mixture between price expectation number 2 and then 3 running to the objective, and then 1 change in order flow to head back down. Right, so a couple of different ways to trade this one based off 3 price expectations. And so the more you practice, the more you see the price expectations, you'll start to see them kind of blend together, and kind of see some signatures in price that kind of tells you what it's looking to do. Is it reaching for another objective? Is it changing order flow immediately, that telling you that that liquidity is enough? Is that liquidity not enough and it needs to accumulate more and then trade back down? Which one is it? And let price show you. Here we come to the end of the day, market hours, so not looking for any trades here. It's just kind of slowly grinding down. Here we have the start of Asia. In typical Asia fashion, we start to have a slow grind up. So with these smaller time frame areas where we can find trades from, all right, price is heading up. Price retraces back down 50%, takes significant lows, and you have a lower time frame change in order flow to the upside. Right, same thing here. You have market structure to the upside, price retraces back, takes out liquidity, and you have immediate change in order flow to head to the upside. Right, this can also be somewhat of accumulation too, because it's such a smaller time frame, smaller moves. Right, like you can just look at this as just price expectation number 1 for the most part, or different ways to enter and find entries there. Right. So here, we have price taking a high. There's no change in order flow really, no MSS. So this ended up being accumulation, right? Then final tap into point of interest, right? Maybe put this like this, right? Final tap into point of interest. So maybe say you entered on this one, and you gave your stop loss a bit of room to breathe. Target accumulation lows, and you have price expectation number 2, where you found a actionable trade from it. All right, so accumulation, manipulation, distribution. Right, pressure is down. Right, reacts off of you had price expectation number 2 here even. Right, accumulation, manipulation, distribution comes back down again. Price expectation number 3 coming down in a hurry. Right, it's fair value gaps running down, takes this low, and what do you have? Price expectation number 1. All right, price expectation number 3 runs this high, no signs of changing order flow, no signs of accumulation. It's running until finally hits a point of interest, and then it's where it accumulates, taps into the 50%. All right, and so you got your trade. Give yourself some room to breathe, targeting the accumulation lows. Right, again and again and again and again and again. Price comes down, takes out these lows, accumulates. Actually, price expectation number 3, right, coming down with energy, with hurry, and once it starts doing that, right, these zones becomes low probability, right? So say you had the zone marked off like that, right? The way that price is coming down, right, it is looking like it's going to run this zone. Right, the type of energy, the type of fair value gap. Here, I mean, it took out this low, and you had some accumulation. I mean, this actually would have worked, right, too, right? This is price expectation number 2. Oops, right, number 2. Accumulation after taking a low, manipulation tap, and takes out the accumulation high. But ultimately, this ended up being a higher time frame move, and London kill zone, start of 2 o'clock, right? So final move down, taking out the liquidity. And what do we see here? Price expectation number 1. This would have been a very nice trade. Right, even on lower time frames, price expectation number 1. Now you're not always going to be able to find trades off of these. Sometimes there's no entry, and you don't need to trade every single one of these setups. You don't need to trade every single liquidity point and every single reaction that you get. Right, you're only looking for the highest probability one, the one that actually gives you a nice entry point that's economical, and so you definitely don't need to trade all these. You really just need two wins a day, and you could be wildly successful, right? Just take it slow and compound, and you again don't need to trade to the extremes. You don't need to trade to make a new swing high or low. Just take your points, take your 1-to-1, take partials at the next liquidity point, and then maybe you have one runner that takes to the swing high where your stop losses move to break even. You want to be taking profits. Right, so here I'll just do a few more here. Price comes up, gives you price expectation number 1, heads down, right? Price expectation number 1 as well, heads up, right? Here we have, this one was a bit tricky. It looked like number 1, but then you had this continuation of the trend. So here, the one way to avoid this, if you were looking to go short here, right? As soon as you have your stop, you have this come back up like that, like you should be out, right? Because that tells you that it's accumulation. And then here tapped into point of interest. Again, this price expectation number 2, accumulation targets the accumulation low. Right, you have here a run. Right, it's running. This kind of looks like accumulation, but it's got fair value gaps. It's going with energy. Right, this did end up actually being number 2, which turned into number 3. Right, ran for further liquidity. It's going to an objective in a hurry. It's reaching for something, and you can kind of tell when it's starting to reach for something. Right, but this one you also had price number 2, and then it turned to number 3, and then you had number 3 again, which was reaching for the low here. Took out the liquidity, and you had the immediate change in order flow to go higher. Right, and so it happens again and again and again and again. Right, again and again and again and again. I remember this one. Right, New York Open, you had price moving with energy, telling you that it's reaching for a higher time frame objective. I had this 50-minute fair value gap marked off, which was also a liquidity point, a high here as a target, right? So you had this move up, is reaching for liquidity. As soon as it came here into a fair value gap, taking this high, I was looking for the 3 price expectations, and here we had a little change in order flow. So I took, I would say, a low risk trade. Maybe give a little bit of room, but not too much, relatively speaking. And I got this beautiful trade like that. right? Price comes down, right? Broke market structure downside. The idea is further downside, right? Price comes up, takes a significant high, and again, we had change in order flow. And if I recall correctly, I took this trade as well. Beautiful. All right, price takes out both of these highs. We have no change in order flow. We have accumulation. So price is accumulating. Where does it accumulate to? This one's not so clean. Excuse me. Takes out the high, accumulation into deeper rebalancing of this supply and demand zone, right? And you might not be taking this one, but as soon as you see something like this, you know you can find something like that, right? You have change in order flow down inside of a supply and demand zone. Okay, so those are some good examples, lots of examples of the three price expectations, right? And how you should be looking for the price expectations after significant liquidity is taken, and based on what price does, learning how to react to it, right? This is not something that you'll learn anywhere else, especially packaged the way that I packaged it, right? Anywhere else that you learn, right? Most people that I see are still taking entries off the 50%. They are predicting price, right? They're looking at the dealing range and they're guessing as to which fair value gap, which order block, which rejection block, which one is going to provide you the reaction, and they're blindly entering, taking a couple losses, and then maybe one of them is going to be a win after taking multiple losses. They're predicting price. They're instead of waiting and reacting to what price is actually going to do. And once price shows you its hand, that's when you want to get involved, right? So reading price, figuring out where you want to get involved, what's the best way to get involved, and demanding market to do very specific things before you're even interested. All right. So in um, summary, couple tips, right? So follow higher time frame market structure and narrative, right? That will give you higher probability. If you're gonna be selective, right? Not just take any high, any low, any liquidity point. Only take the ones that are aligned with higher time frame market structure. That'll give you a higher win rate. Look for your points of interest and mark out your charts, right? Mark off your supply and demand zones, mark out your fair value gaps, mark off your draws on liquidity, right? And demand your points of interest and look for reactions. Look for price to show you its hands once it takes the liquidity and it shows you what it actually wants to do after doing that, right? Look to see how price reacts at your POI after taking draw on liquidity, exactly like I said. All right, take profits, right? You don't need to be right to make money. You don't need to be, like for example, like ICT, always targeting the opposing liquidity, right? Because price doesn't have to go all the way there. Oftentimes it doesn't, right? So take your profits, take your one-to-ones, take your low-hanging fruit, and leave runners if you so choose. But that's how you will be consistent and you will see your wins compound, right? Like I said, you don't need to trade every high or low. These price expectations are what you can expect to occur most of the time. However, market can do whatever it wants, right? So these are three price expectations. But as you saw in some of the examples, sometimes price can do a mix of them. It can sometimes be a bit tricky or fake you out, right? So you'll need to backtest and get experience about how to read price and not get tricked, right? How to be more patient, disciplined, how to demand things from the market, right? And at the end of the day, market can do whatever it wants, doesn't have to follow any of these price expectations. but generally in normal price conditions, it does, right? It follows these again and again and again and again, and it always does the same thing. Market will give you different variables, right? It doesn't, um, it may accumulate longer, it can accumulate shorter, accumulate higher, etc., etc., etc. Right? It might not give you an entry, it might give you an entry, might give you 2022 entry, it might not. There are a lot of variables involved, right? But again, as long as you can understand these three price expectations, it'll give you a good idea generally of what price wants to do after taking liquidity. Right? Be selective, choose the best setups that you've seen repeatedly in your backtesting. Like any video that you watch online, any models that you see online, obviously you're not going to immediately take a live trades with it. You're going to backtest the heck out of it, and you're going to implement it into your own trading plan, right? You're going to backtest, make sure that there is an actual edge, and decide how you want to implement this knowledge that you have now gained, right? You've now gained a way to read price and to better find find entries at certain locations that happen repeatedly, right? So backtest this and implement it. I hope you find a lot of success with this model. And again, if this has benefited you in any way, please like, subscribe, and share, as this help this channel to grow and let more and more people learn some of these strategies. All right. Well, I really do hope you enjoyed this one, and I will see you on the next one. Have yourself a great day.